Now we're going to talk about legging into a debit spread, and we trade option purchases in our account. We like to diversify. We trade three different option strategies: the option purchases, the debit spreads, and the profit guards spread. So now we're talking about legging into a debit spread. And Prime Trade Select has produced a lot of profitable call option trades over the years. So this always poses a dilemma. If you're long a call option, do you hold on to that call option in case there's further upside profit potential, or do you take profits on your call option in case the stock declines, with the possibility that your profitable trade is going to turn into a loss? So we never like to see that happen. So what we do is, if we have a profit in a call option purchase, then we'll leg into a debit spread at a later time. And that's one of our trade management rules. And it's just prudent to protect those profits either by legging into a debit spread or legging into a profit guard spread if you have a profit in a call option purchase. So whenever we have a profitable call option trade, we'll sell to open a call option with a higher strike price at a later date to create a debit spread. And when you sell to open a call option, your trading account receives a cash credit for the option premium that you sold. So if you sell a call option with a 4-point premium, $400 in cash is credited to your brokerage account. And if you purchase a call option and the call option profits, the sale of a call option at a later date generates a cash payment, and that cash payment allows you to increase the profit potential of the existing call purchase by as much as 100%, and it also provides downside protection in the event the underlying stock decreases in price. So if we own a call and we have a profit, and then at a later date we sell a call option, we'll receive that cash payment into our account equal to the option premium. So once we receive that cash payment, then that increases the existing profit potential of the call option purchase, and then also provides downside protection. So the call option that you purchase, of course, will profit if the price of the stock increases. The call option that you sold will profit if the price of the stock decreases, and your risk is limited to the cost of the spread. And we use Prime Trade Select to select a high probability trade, and after we purchase a call option, we use the trade management principles we discussed to manage the option purchase. And if we have a 30% or higher profit in the call option purchase, then we'll sell to open a call option with a higher strike price to establish a debit spread. So that's part of our money management rules, and we'll leg into a spread if we have a profit on a call option purchase. And our other rule for legging into debit spreads is if the underlying stock or ETF is still on a buy signal, then we'll roll over the spread at option expiration. So let's look at an example of legging into a debit spread. AMAT is the symbol for Applied Materials. AMAT was on a Prime Trade Select buy signal, so we bought the 40 strike call at 778. So this is our brokerage account portfolio report. This is the price paid for the 40 strike call was 778. So the option was trading at 1511. So we had a profit in this call option purchase around $13,000. So we used Prime Trade Select. We got a low risk entry, and we had a profit on this call option purchase. So at a later date, we sold the 50 strike call at 375. So this created a debit spread that expired in about 5 weeks. So had a profit on the 40 strike call, so at a later date sold the 50 strike call at 375, and at the time AMAT was trading at 52.48, so this created a debit spread and a net debit of $403. So we were risking $403 on this trade, and that's our maximum risk. So this was the in-the-money spread as AMAT was trading at 52.48, and we bought the 40 call and sold the 50 call. So that in-the-money spread gives us more downside protection and a higher probability that the trade was going to be successful. So let's take a look at the profit potential on that. Again, the stock was trading at 52.48. We bought the 40 strike call. We had a profit in the 40 strike call. So at a later date, we sold the 50 strike call at 375. And we can see that if AMAT was flat or goes up at all at option expiration, we're going to have 148% return on this debit spread and $597 profit. So when you leg into a debit spread, you typically will have a higher percent return because you already had a profit in the existing call option. So in this example, 148% return if the stock is flat, and if it's down 10% at option expiration, we have a 79% return. So this is an example of a leg in on a debit spread for the AMAT 40 strike call after we had a profit in the call, and then legging in by selling the 50 strike call at 375. Here's one more example for legging into a debit spread. This is for ISRG, and that's the trading symbol for Intuitive Surgical, and ISRG was on a prime trade select buy signal, and our portfolio report shows that we bought the 280 strike call at 45.60, and it was at the time was trading at 90, so we had a profit, about a $22,000 profit in our 280 strike call purchase. So we wanted to protect those profits, and at a later date we sold the 370 strike call at 15.10. So once we sold the 370 strike call, that created a debit spread, and ISRG was trading at 379. So again, this is another example of an in-the-money debit spread with a high probability of success. The net debit on this trade, this is a higher price stock, so the net debit was 30.5, so that's $3,050 was the net debit on this trade. And again, this was another in-the-money spread, and those in-the-money spreads, of course, give us more downside protection and a higher probability that our trade will profit. So let's look at the profit loss potential. ISRG trading at 379.24, bought the 280 strike at 45.60, had a profit. Later date sold the 370 strike call at 15.10. If the stock was flat at option expiration, we have a $5,950 profit and 195% return. And if the stock was down 10% at expiration, we'd have a $3,082 profit and a 101% return. So you can see with these spread leg-ins, you get a higher percent return in generally than you would if you simultaneously bought and sold the call option. So we initiate the spread trades both ways. We'll do simultaneous entry, and we'll also do leg-ins just to diversify our portfolio. So we have a option advisory service that makes trade recommendations for debit spreads, and we send out emails for email alerts whenever we enter a trade or exit an existing trade. And we also keep a record of all open trades, so the members can see how the trades are performing, and that's updated regularly. And we also get the 6 option calculators with membership in the Inner Circle Option Advisory. And here's an example. This is a trade alert we sent out last week. This was for Netflix, and we were buying the 270 call and selling the 290 call, and this was for May. So this trade's about 2 months out, and we used the spread calculator. In this trade at the time we entered, it had a 34.6% profit potential if Netflix was up, down, if it was up, flat, or down 5% at option expiration, and if it was down 10% at expiration, the spread had a 20% return. So this is just an example of one of the alerts we sent out to initiate a simultaneous Netflix debit spread. This is a current listing of all our option debit spreads in the advisory service. This column lists the option that we own, the entry price, the quantity, the last price, the dollar profit in this column, and the percent return. And as of yesterday, we had $826,000 in open trade profits and 181% return for our option debit spread. So if you want more information on joining the Inner Circle and advisory service, we have 3, 6, 7, 8. We have 8 different strategies in the Inner Circle, including the option debit spread. So if you want to get an update on how these strategies are performing, if you just log on to chuckhughesic.com and click trade results, you can get updates on these strategies.